Welcome, everyone. Today, my guest is Lead Analyst Logan Mohtashami to talk about the jobs report, the Fed, inventory, and so much more. Logan, welcome back to the podcast.
It is wonderful to be here, Sarah, because it's always Jobs Friday and all Jobs Fridays are wonderful.
You know, it has been a whole jobs week. We've had so much going on this week. Okay, catch us up to speed on Jobs Friday. What's the headline for you there?
The labor market's slowing down. And it's not just this jobs report, it's the accumulation of all the data that we've seen recently. Now, the headline number actually beat estimates. That's not a surprise. I think we've beaten estimates like 13 times in a row. But when you take the revisions, we're negative 149,000. If you take a 3-month average, it's about 182,000 per month now. That takes us back to early January 2021. If you take the job openings data that we saw this week as well, then the labor market is slowing down. We went from 12 million job openings to roughly around 9.5 million. With that context, the rate hikes, the banking crisis, everything, the job market is slowing down, running into a economy that has to deal with higher rates and a tightening of the labor market. So this is textbook 101 what the Federal Reserve wanted. Job openings, I think getting to 7 million is their target. And with a 3-month average being as low as it is since early 2021, that's something they're happy about. And also wage growth is just slowly moving down for some time now. The year-over-year average, even though it picked up month to month, the year-over-year average has proven once again we are not in the 1970s inflationary scare or the wage spiral running out of control, and everyone has inflation is about to go rampant again.
So is this enough for the Federal Reserve to go, okay, this is the job, this is affecting jobs and this is where we're going to change?
No, not yet. Again, my entire Fed pivot premise is on jobless claims data breaking above 323,000 on the 4-week moving average, and we're not there yet. So once that happens, I think they will feel much comfortable. They might even feel much comfortable if job openings gets back to 7 million. 7 million is pre-COVID. So, the question is, was that the last rate hike we saw? If the crisis gets worse, I mean, in theory, they should have been done a while ago, right? Because of the lag impact. But I think they are so petrified of the 1970s that in their minds, a recession to them, it's like a badge of honor. That look at us, we're the Federal Reserve. Paul Volcker did it. We put us into a deep recession. We're going to do it. We're going to do it again just to beat inflation. Well, this is not the 1970s. The bond market has shown it. Inflationary data has shown it. Where the growth rate is already cooling down. It just takes a little bit more time. And this is why I always talk about the Federal Reserve needs to endure, right? It can't panic. Like they get these panic episodes, like when mortgage rates got to 6%, Kashkari came on TV and said, oh my God, 6%, you might make our jobs harder. So we have to evolve, hopefully, from that stage. But it doesn't look like to me that they're in that new mindset yet.
What else has the Fed done this week that makes you go, okay, where are they in this process?
Well, I mean, Chairman Powell actually talked about, he doesn't believe there will be a job loss recession. And again, the job openings data, which is very important to me, which everyone hates on Twitter finance. But they believe that data line can go lower and lower and not have a job loss recession. So we're talking about every report for many months. Again, I think that the whole debate with the Federal Reserve, with a lot of market people, is that do you not believe in the lag impact, which means that the Fed rate hikes won't be hit until 12 or 18 months later. If you believe in that premise, you should stop, because the whole idea for the Federal Reserve, and this is really key to the entire Federal Reserve's talking point, they don't want to cut rates. So they said this a few months ago or late 2022 that we don't want to raise rates so much so fast that we are forced to cut them. Well, then what are you doing? So I think there was between like December, remember we talked about somebody like spiked the Fed's eggnog?
Yes.
something happened toward the end of last year and early part of this year that changed their mind, and it just spooked them. And then they were like talking about 6% Fed funds rate, or and even with the banking crisis situation, which people are talking about the tightening of credit, there really wasn't a very good reason to hike rates at the last meeting. But they'll say, well, if we don't hike rates, people are gonna think that we know something. No, we don't think you know anything. Don't worry about that. We're all good here. Right? We are all like, oh my God, the Federal Reserve. No, you're old and slow for a reason. We're good. Take a look in the mirror. You might not know something, but I think we're starting to get to that framework where the Fed just goes, okay, let's see what goes on. Right? Clearly, it's changed since the banking crisis. There's no more 6% Fed funds rate. We might need to go to 7. We had some crazy people talk about 7% Fed funds rate, or we need 7 to 8% unemployment rates to defeat inflation. You have to endure with inflationary data because clearly wage spiral is not happening. We saw this in the data for 12 straight months. If people believe in reading. And clearly the shelter factor over the next 12 months is going to be much different. So this is where we're at, and we just, again, take it 1 week at a time, and that's why we do the tracker, so we could keep an eye on the labor data. And so far, jobless claims haven't broken yet.
Well, and also, I mean, we're doing this in the midst of several bank failures, and I think you and I talked about this the other day, and you gave me a number of how many banks are in that list right now.
Yeah, I mean, you could in theory put 28 banks at risk, right? And I think what happens to me, when I see what happens in the stock market with banks, and we've gotten to the points where people are saying we have to stop short sellers from shorting these bank stocks and driving them lower, because what happens in the stock market is that they'll smell blood and everybody will short the bank stocks, and the bank stocks will be going down 20, 30%. And then in that light, people think, oh, I got to take my money out of the bank. So this is why it is such a wonderful thing for all of us in housing that Freddie and Fannie are not publicly traded companies. The failure of, Mark Calabrio of not getting what he wanted was one of the biggest blessing in disguises ever in housing economics. He did not get to create Freddie and Fannie out of conservatorship or pull them out of conservatorship, so they have to deal with the stock market. That was a blessing in COVID. That is an unbelievable blessing right now. So we do have to thank Mark Calabrio for not being able to pull that off, because the United States of America, the people of this country, benefited from that in a very big fashion.
So just to close the loop on that, the Fannie and Freddie have nothing to do with the bank failures. What you're saying is if they were publicly held companies, they would be under that same sort of pressure.
Yes, their stocks would go down and people would credit would get tighter. And I mean, look at the mortgage-backed security spreads are already bad. Like, they're not like at all-time worst levels, but they're really bad. I mean, to give you a baseline case, when people talked about 8 to 10% mortgage rates last year, they were really talking about the 10-year yield getting to 5.25, and having bad spreads. There's your 8 to 10% mortgage rates. It could happen in theory in that light. And here we are, mortgage rates are at 6.5. The spreads are terrible, right? Imagine if the 10-year yield wasn't here at the Gandalf line and we're higher. Yeah, we're talking about 7.5, 8% mortgage rates at this point. So things could be a lot worse in housing. So I know a lot of people, the spreads are really bad, and the banking crisis isn't helping, and jumbo loans are going to get hit, but it could be much worse than where we are dealing with today.
So let's talk a little bit about mortgage rates and the 10-year yield and the Gandalf line, and we have a listener question. So all of those things. So first of all, what happened with mortgage rates this week?
For as wild as the news was, it wasn't too crazy with rates. I think it's 6.75. We got down to 6.43. The spreads are just terrible. So mortgage rates, last year would be at 6%. Today.
So spreads again.
Oh, the spreads is between the 10-year yield and the 30-year mortgage rate were above 3%, so usually it's between 1.60 to 1.80. So whenever you see somebody do a 3% spread, that means mortgage rates should be almost 1.25 lower than where we are today. So today we should have 5.25 mortgage rates. If it was in the previous expansion, that's where we'd be. Could everyone imagine what housing would be like if we had 5.25 rates, right? Even the craziest of the craziest housing crash people would have to like move the needle to next year. But that isn't the case. The Federal Reserve doesn't care. So we have to deal with this. And I think there's a frustration that the spreads aren't getting a little bit better. They're getting worse. And that's, in a sense, the banking crisis that, when I went on CNBC a few weeks ago, when we talked about banking crisis, it's not so much credit getting tight in terms of loans really in scale getting away because Freddie and Fannie are are in conservatorship, but the spreads have gotten worse and they're just staying bad above 3%. It's not an effective market. And this is why I say the mortgage market here in America resembles like a third world country when countries have to deal with our dollar getting stronger and their rates are really wild and their financial markets aren't solid. So this is the reality we have to deal with. But again, if the 10-year yield was at 4.25 or 5%, things would be much worse.
Hi, I'm McKenna Clay, Events and Programs Specialist here at HW Media, and I wanted to invite you to our upcoming event this summer. A theme we've heard from housing leaders this year is the importance of relationships to not only survive, but be strategic in 2023. And that's why we decided to invite the top C-suite executives and leaders in mortgage to join us at Gathering of Eagles in Austin, Texas from June 18th until 21st. Now, Gathering of Eagles has historically been exclusive to the nation's most elite brokerage, association, and team leaders and C-suite leaders. But for the first time this year, we're opening up the audience to include execs from mortgage, title, and insurance so that you can connect and build vital partnerships for your business. If you want to learn more, visit the events page on realtrends.com and you can get registered today to come hang out with us in Austin.
Things would be much worse. So tell us, how did the Gandalf line, first explain what that is and how it held this week among so much chaos? Tell us.
I know the Gandalf line is annoying people when bond traders start to tell me their own models for the 10-year. It's funny. I had actually one bond trader on Twitter say, I think you just guessed that number with your gut. I was like, I have like this whole forecast model that I do every single year, and I will take it on any single human being on planet Earth any day of the year. And I'm trying to explain to him that some of the calls that I made in the previous expansion. So the Gandalf line, when the year started, one of the things I talked about is that between 3.37 and 3.42, this area is going to be tough to
For the
break.
10-year yield.
The 10-year yield, yeah. So the 10-year yield kept on going there and bouncing off, kept on going there and bouncing off. So I thought, what is a cultural reference that we all could, recognize? Well, it's Gandalf saying, "You shall not pass," right? Balrog's coming in and it's 7 times. I think this is going to be the 8th time now. It just keeps on bouncing off. Now, we did break it for a very short period of time, the height of the banking crisis early on. It broke us under there for like a day, and then it just shot right back up. So here we are to this week with all the drama that we've had. It bounced off again. And we had a question from a listener. Is there any historical value to the Gandalf line? And I would say this: the way I look at the bond market and mortgage rates is probably going to be different than everyone else's. But I always tell people, follow the body of my work going back to 2015. 2015 is when I started to incorporate this. So what you need to realize is that every year in the last decade, I talked about, we're just going to be in a range between 160 and 3%. It's really boring, but that's what it is. And when the next recession hits, the 10-year yield should break underneath 160. The only time that we were tested really was in 2018. In 2018, the 10-year yield got to 3.25 on November. That was the day where 50 economists said mortgage rates are going up in 2019. I was like, no, we're going to go down the long-term channel, right? So in 2019, I talked about 1.94. The 1.94 is a big level of my work. So I put these technical levels and economic models, I try to incorporate them together. It's not going to make sense to a lot of people, but when COVID happened, I was like, okay, the 10-year yield could get to negative 21 basis points in 62. Those are my lines they're not so much, I would say, historical lines. I mean, if anybody looked at the chart, you could see that that line had possibly a chance to break. But for this year, if you look at the forecast I talked about, I don't think that level breaks or get below 3.21% until the labor market breaks. Breaking means jobless claims get to a certain level. So just sticking with my belief on the labor market incorporated that self into the Gandalf line. So it's not, if you don't hear about that level from anyone else, that's because everyone else has their own view on it, or they look at the charts differently. There's nothing wrong with that. It's just everybody has their own thing. This is mine for this year. If you go back to my previous predictions, I do these things very particular. Even in 2021, I said the 10-year yield between 62 basis points and 1.94, but the focus is we're going to create a range, like we're going to have a good range between 1.33 and 1.60. Just harped on that over and over again. We got that in 2021. So how I look at it is not so much maybe in historical, it's just how I incorporate the 10-year yield mortgage rates and with the economic data. And it's crazy, who wants to predict bond market channels? That's like the craziest thing ever. But there's a lot more money in the bond market than in the stock market. So I think there's some frustration from people that have a lot of money in the bond market that, hey, listen, all these data lines are recessionary. The 10-year yield needs to go. Yes, it will. Just give it a little bit more time. The labor market breaks, it should break. And this is why one of the questions I give to market participants, now that we're in May and that channel for 2023 has held, do we believe that the 10-year yield will be north of 4.25 when the labor market breaks or under 3.21? Because a lot of the bearish cases for housing last year was in October that mortgage rates would get to 8 to 10%, the 10-year yield would get here. We wrote that article on October 27th, stating our thesis, our premise, why mortgage rates will fall or the 10-year yield will fall. And a lot of that on that day was based on the Fed's main recessionary indicator flagged itself on that day. And then we just go off from that. So I wouldn't say like a historical reference. It's just for me, that line meant a lot so much that many months ago I said, okay, this is going to be hard to break. And now that we've seen it, I'd have to go back in history to see have we ever had something this strong within a year of crazy. I mean, it's one thing if the market was boring and nothing was going on, but all hell is breaking out. This is a banking crisis, and it's held its ground.
It has held its ground. I would like to have a programming note here. As always, when you say we wrote this article or we formulated this, you really mean you. Your basketball coach, I know it's always team, but I just want our listeners to know you write the articles, I edit them. I am not an economist nor a lead analyst. So this is your work, and I'm happy to be part of it, but it's not really we.
Sarah, if you bring this up one more time,
I'm going to keep bringing it up.
We're going to do salsa dancing at the conferences, okay, in front of everyone.
I can actually do salsa dancing, but listen, I am not part of writing these articles, so I just want that to be clear. I wish I could.
Everything is a team. We, all of us, not one person, all of us put together.
This is why I keep bringing it up. Yes. Okay. So we had purchase apps this week, and we still need to celebrate the fact that we can say we are actually seeing a spring increase in inventory.
Yeah. Total active listings for the last few weeks have finally started to risen. That's positive. New listings data, even though it's trending at all-time lows, it's having its seasonal increase on a week-to-week basis. These are all good things. We don't have too many weeks left for the new listings data to grow, about like 8 weeks before it gets its seasonal decline. But it's a good thing that, I've always said that a seller is also a buyer. So you get some people listing more, they feel more comfortable wherever mortgage rates are. So I'm not a mortgage rate lockdown person, but one of the things that new listings data was trending at all-time lows when mortgage rates were at 3%. But when you list your homes and you sell it right away and you're buying another one, those homes do not stay in the active inventory list, right? Because they get taken out very early. But you want to see people in this light, because 30-day delinquencies, 60-day delinquencies, 90-day delinquencies are all-time lows. New listings we want to see people feel comfortable in this environment. And last year, when rates got to 6.25, things changed. I think a lot, so not everyone, but a few people were gun shy, and you can't blame them. I mean, mortgage rates went from 3% to 6%, 6% to 5%, 5%. That's not a functioning marketplace. That's a dysfunctional country, and on the economic sense, you can't make big lifetime decisions when you have rates be that wild. And again, the Federal Reserve didn't care. The whole housing resident is just whatever. This whole thing has to crash, and it did. I mean, home sales crashed. Housing went into recession on June 16th, 2022. It's funny. I still have this debate with people. I say, housing went into recession in June. What are you talking about? They're like, no, it's a bull market because prices haven't crashed 20%. We have some really, really like sad middle-aged men out there that just focus on things that have no meaning or value. So we'll wait for the tracker to come out on Sunday. By the time you hear this, we'll have the data out there, and we just want to see the traditional inventory growth. All good. There's nothing bad about it. Supply is a good thing, and take it from there. Of course, much different marketplace now than we did last year. And Purchase Apps showed us that starting from November 9th last year. And the builders have really taken an advantage of this marketplace by pushing down rates for their buyers. So, of course, again, it's a rate situation. And I always like to remind people, we have over 155 million people working. When the labor market breaks and rates fall, and you get maybe one or two negative reports, remember, there's 155 million people still working. COVID, we lost 20 to 30 million people very quickly, and housing demand was very stable, right? That was fine. Why? Because 133 million people are working. We're going to have not only the same situation here, but we're going to have a lot more workers and a lot less volatility, right? Because of the chaos of COVID. But it really depends on how low the 10-year yield goes. What's the mortgage-backed security market? How's that going? And that'll be a big talking point going out in the future. But as of now, labor market's just slowing. Wage growth is slowing down. These are things that the Fed wants, but it hasn't broken yet.
Anytime we talk about inventory and you say that line about how, active listings, and when you're looking at new listings, how you look at that. And you mentioned that things that go on very quickly and then get bought don't show up on those numbers. I got a question just a couple weeks ago after you said that, where it was like, is this the shadow inventory? Are there like
no, that's
no.
not.
So this is what I want to, are there millions? So here's the theory that there are millions of homes in a shadow inventory. So explain why that's not what you're saying.
We're still talking about the shadow inventory.
We are. I still get questions
crazy.
about it.
I know. I see it all the time. There is what we call vacant inventory. It's like 14 million homes. The shadow inventory is usually talked about by anti-central bank people. So it's just a trolling act, right? It's just designed to create fear. Like Batman creates fear. Where's the bat costume? Everybody sees the bat light. It's fear. Like criminals get scared. These people just try to make it seem like there's all these active listings. And for some reason, even though this has been in a downtrend since 2008, these homes are going to come onto the market. And we just had a podcast about this this week, or last week. The next stage of the housing discussion is going to be the foreclosure fanatics, right? That's not the shadow inventory. The shadow inventory is a mythical creature at this point. There's no distressed properties, right? We're going to have foreclosures rise. They're just because the backlog of foreclosures are rising. And like some podcast guy said, oh, foreclosures are up 700%. It's like from 1 to 3, whatever, it's like, so it's not that just, it's crazy for me to say this, but I try to advise my housing crash friends. You might have to push your foreclosure thesis to 2025. And the reason I say that is we're in May, we're still creating jobs. When the job loss recession happens, if you're counting on new foreclosures, it's a process, 30, 60, 90 days. So 9 to 12 months minimum. In some cases, it's even longer than that. That pushes out, we're already past, the midpoint of 2024. So you're almost to the point where you have to look at this in 2025. That's how the foreclosure process works. The shadow inventory, it's just not a thing.
And the way that it works into that whole crash theory is that at some point, millions of homes we don't know where these are, why people would be holding back, but they're all going to come on the market at the same time, flood it. They're going to crash prices. There's going to be all this stuff. And we're like,
Sarah,
listen,
have you ever heard of the silver tsunami?
yeah.
The
Yes, very
silver
true.
tsunami was
Yes.
from 2015 to 2025 because the baby boomers first turned 62, which Sarah's not a baby boomer. No.
Thank you.
It's the first baby boomer turned 62 in 2008. So starting in 2015 would be the biggest increase of active supply ever recorded in U.S. history, because mythically speaking, all the baby boomers were all going to sell at the same time. And then they can't find homes to buy because there's no millennials to buy. Crackpot? Anyone? I mean, it's just, we are in 2023, 26 to 32 million active listings. We are at 980,000. Missed it by this much, right? So these are, listen, I spoke to a group of real estate agents and I told them, follow people like me that actually have the data, and we create models to show when there's actually like stress in the listings data. You usually need to see it in the new listings. It would take off. The inventory scare that people talked about last year, which was hilarious, new listings data was still trending at all-time lows. We had a few weeks where we were up year over year, but nothing like what we saw before, and that's why total inventories are still all-time lows. So this is year 11 now that they're doing this with the shadow inventory, and I promise you, they will not stop. Even in death and the afterlife or wherever they are, they will talk about the shadow inventory in the pits abyss of hell or wherever. It is their sacred cow. They love it so much. And here we are today. Total active listings are near all-time lows. New listings data is at all-time lows. 30, 60, 90-day delinquencies are near all-time lows. Everything they promised us hasn't happened, and I promise you they won't change either.
Well, and listen, if someone's out there sitting on all this shadow inventory, go ahead and release some of it. We need, if we had 1 million more homes on the market, that would just juice the spring and summer home buying
Oh
season.
my! Listen, I would.
We'd be
I
so
would.
happy.
I'm going to throw a party when I get back to the 4-decade average of active listings, because I believe choices are a good thing, and sellers are traditional buyers. That means they're good to go, right? But we just had the biggest crash in sales in 1 year, and total active listings are near all-time lows. So my job is to try to explain how inventory channels work. And for me and my work, it's really based on credit channels, 30-year fixed mortgages. Lending is back to its boring roots. So it's not as exciting as people make it out to be. And the whole sell to be homeless things, I don't know who convinced these people. I mean, you got to, whoever that is, give that person a prize that this was ever actually a thing, that people were going to rush to the market and sell, and they're going to be homeless. And I think when we talk about just general inventory, that's why the builder stocks are doing well, right? The builders have capitalized on this situation. They realize, wow, we don't have that much competition, and we could really force mortgage rates down, and it'll make our product more valuable because you're buying something new, but the rate of like this. And traditionally speaking, new home buyers are older and make more money. So plus for them. But the whole concept of how inventory works in this country has never been good. And it really started in 2018. After what I saw in 2018, when rates went up to 5% and home sales went from 5.72 million to like 4.94 million, everyone was screaming, the bubble crash is happening. I was like, inventory is not even growing year over year. What's wrong with you people? I was like, they don't read. And like when it finally happens, when we actually have a home sales crash, back then purchase application data wasn't hardly negative, but when that happens, they're going to scream inventory. And it's just not the case because credit channels are much different. And we don't believe in the concept of people selling their homes to be homeless. I mean, if you have kids, you're probably going to lose your kids. Police would probably take your kids from you. I mean, it's just basic common sense.
Basic common sense. And some of the things to watch for, I follow a lot of accounts, right? Even some very well-known accounts and some accounts with a lot of people. And here are the kind of things they say, like, this is the beginning of it, or something bad's
Sarah,
about.
it has been beginning of it since 2012.
I know. It's crazy. It's crazy.
Trust me, I know.
Let me put in a plug for you are speaking at Gathering of Eagles, which is Real Trends has been putting on this event for over 30 years. It's going to be June 18th through the 21st at Omni Barton Creek in Austin. You're going to be giving a great talk. Mike Simonson from Altos Research will also be giving a forecast or, talking about inventory. You're going to be talking about mortgage rates and the economics. He's going to be talking about inventory. We have a whole bunch of other incredible speakers. We also have a pickleball tournament. Have you ever played pickleball?
No, and I never will. There's a pickleball bubble going on right now. Okay, so this will fade in time.
I'm gonna play. Come on, don't be that
There's
old
no-
man. Like, get off my pickleball
I'm
lawn.
a basketball player, so play basketball and football. We could go, but pickleball, no.
Okay, but people are really excited about. We have had.
I'm sure they are. That's what every bubble is. Everyone is really excited by pickleball. So it's just a bubble. You run the numbers out here. It's like all of a sudden everyone's playing pickleball. So
you're missing the point. So we want people to come to Gathering of Eagles in June. Hear Logan, hear Mike, and hear just some incredible people. And you can find all of that at realtrends.com. But Logan, thanks for being on and giving us your insight as always.
Pleasure as always, Sarah. And we're going to be salsa dancing now because you talk too much about I and we. And no, it's going to be
my punishment,
me.
Huh? Okay.
Yes.
I think that's the audience's punishment, but we'll see. Thanks so much.